Shriram Pistons and Rings is undergoing a massive transformation, and the Q3 FY26 results prove they are no longer just a piston company. Now rebranding as SBR Auto Technologies, this automotive giant is pivoting from traditional engines to a multi-product tech player, and the numbers are impressive. We are seeing a 20.7% growth spurt that marks a major strategic evolution for the brand. The Q3 scorecard is officially in, and the top line is surging. Consolidated revenue hit 1,023.2 crore, up over 20% year-on-year, while EBITDA followed suit, reaching 238.9 crore. On top of that growth, the board has declared an interim dividend of 5 rupees per share, signaling a strong verdict that demand remains high and acquisitions are closing successfully. It's official. Shriram Pistons and Rings is now SBR Auto Technologies Limited. This isn't just a name change, it reflects a deliberate shift into a multi-product technology player. The strategy is aggressive diversification into powertrain-agnostic sectors, which now account for over 35% of revenue, catalyzed by the 100% acquisition of Antolin Lighting and Grupo Antolin India this January. Consolidated revenue from operations jumped from 847.9 crore to 1,023.2 crore this quarter. This surge was driven by massive domestic demand and a highly optimized sales mix between passenger vehicles and two-wheelers. To put this in perspective, while the industry production growth was 9.1%, SBRL outperformed everyone with a volume growth of 17.8%. Efficiency is the name of the game here. Absolute EBITDA rose to 238.9 crore, and despite global inflationary pressures and rising operational costs, the company kept the margins flat at 22.6%. They achieved this through rigorous cost optimization and smart backward integration strategies to protect the bottom line. If you look at the reported profit after tax of 125.7 crore, it only grew about 4%. But there's a catch. The company took a 25.2 crore non-recurring hit due to a regulatory cleanup rather than an operational failure, meaning the underlying earnings power of the business remains incredibly robust. The company is successfully moving away from its legacy ICE, or internal combustion engine dependency, which now makes up less than 65% of the business. The growth is coming from powertrain-agnostic sectors like EV motors and controllers via SBR EMFI, precision injection molding with SBR Takahata, and those new lighting and interior segments from Antolin. To fund the massive Antolin acquisition, the company's debt-to-equity ratio spiked from 0.16 to 0.63. This was a deliberate move, issuing 1,000 crore in commercial papers to secure the deal. While the leverage is higher, the company has a history of being net debt-free and maintains a healthy operating cash flow of 257.7 crore. Even in the middle of this aggressive pivot and high capital expenditure, management is keeping its promise to investors. They've maintained a consistent dividend track record by declaring a 5 rupee per share interim dividend. This represents a payout ratio of approximately 50%, balancing growth with immediate returns. No investment is without risks, and there are 3 things to monitor here. First is labor volatility, as new state rules for the labor code could cause more one-off costs. Second is EV speed. If adoption slows down, it could delay the return on their new motor investments. And finally, they still depend on steel and aluminum prices for their core piston margins. Let's look at the vitals. The debt spike to 0.63x needs to be watched for interest coverage. On the plus side, receivables are stable at 515.5 crore, showing no signs of collection stress. Most importantly, remember that the bottom line was distorted by that one-time labor provision. Don't let the 4% PAT growth fool you about the real performance. The Antolin acquisition is the real game changer for the road ahead. It adds approximately 1,179 crore in potential revenue based on last year's figures. Beyond the money, it unlocks the high-value automotive interior segment, which is completely distinct from the cyclical nature of engine manufacturing. So why put SBRL on your watch list? They are successfully transforming from an ICE brand to an auto tech powerhouse. They're outperforming the industry with double the average volume growth. And they're acquiring smart inorganic growth through Antolin, while keeping EBITDA margins above 22%. If you found this earnings deep dive helpful, make sure to like, save, and share this video. Follow and subscribe ZinvestZ for more such smart investing insights. Thanks for watching.